Good morning and welcome to this Wednesday, December 14th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Currently, we have futures relatively flat. Dow futures down a point, S&P down a few, Nasdaq futures down about 15-20. We had big news out yesterday with the CPI. The November CPI came in better than expected. We had a huge gap up at the opening bell, and then we saw selling throughout much of the day. Did finish higher, but it just didn't feel nearly as bullish because of that huge gap up and failure throughout the day. But I think we've got a fairly wide range here right now. I think the high yesterday is going to be a key resistance level going forward now. And to the downside, we had that big gap up with the PPI from the CPI from the prior month. So October CPI, we got that gap up on November 10th. I think that's kind of the floor, and that's the range that I'm following for now. We'll see whether or not that continues to hold. We have a big Fed meeting coming to a conclusion today. They began the meeting yesterday. Today at 2 p.m., we will get the latest policy statement from Fed Chief Powell. I think it's fairly widely expected that we will see 50 basis points, but what does the Fed say? That's going to be the key, and that is usually the driver of extreme volatility after the announcement. So expect just about anything after 2 o'clock. It is option expiration week. We had a Max Payne event last night, and there's still potential downside. We really didn't have too many option issues until we got that big gap up yesterday. And that created a little bit more potential downside. That may have been why we saw the big sell-off during the day. Very difficult to say. But anyhow, we do have that coming up on Friday as well. So it's already been a volatile week. It may stay that way. So you better be prepared for big moves in either direction. All right, let's go ahead and take a look quickly at our website. For those of you who are new to Earnings Beats, welcome. We certainly appreciate you joining us here for Trading Places Live. I do want to mention we've got a huge event coming up on Saturday, January 7th. I'm going to be talking about this quite a bit over the next few weeks, but this is our Market Vision 2023 event. This is where we try to take a look ahead. Not only tell you what just happened in the prior year and heading into the new year, but what we think could happen or what we believe will happen in 2023. I've got a couple of really good friends, great technicians coming over from Stock Charts to join me. I can go ahead and announce those. I guess we don't have it on our website just yet, at least not complete. But Dave Keller, Stock Charts Chief Market Strategist, will be joining us. Of course, Dave is the host of the Final Bar over at Stock Charts, which airs at 4 o'clock on Stock Charts TV each and every trading day after the market closes. Joyous de Kempenaar, if you've ever looked at the RRG charts over at Stock Charts, he is the creator and founder of those RRG charts. He'll be joining us, and Grayson Rose. Of course, many of you know Grayson. He's been on our shows with us. He's the VP of Operations over at Stock Charts. Always has a lot of interesting things to talk about. So we're looking forward to having the three of those gentlemen join us on Saturday, January 7th. This is a free event. I intentionally, we make this free because we want to try to get out to as many folks as possible. So you need to register now. This place will be packed on Saturday, January 7th. There will be no seating available. Please register now with your name and email address. If you have friends, family, anyone that you want to have come in, make sure they go to earningsbeats.com and get set up. Register now. All right, let's talk about what happened yesterday. So we got that CPI out. It was the November CPI, and we came in below expectations. This is the second month in a row. Remember, the Fed was talking about, hey, we need to see a series of reports that show inflation is moderating. Well, here's the second big one. 2 CPI reports in a row coming in below expectations, not just below expectations, but in a range where we're getting back, into that 2.5% CPI at the core level. I mean, when you start talking about 0.2%, which is what we had yesterday, we were expecting 0.4, came in at 0.2. 0.2 times 12 is 2.4. Last month, it was 0.3, or actually 0.27, which was rounded to 0.3. And that's a little bit above 3%, but that's a whole lot better than the 6.5% annual rate that we've been looking at, and certainly better than a lot of these individual months where we've seen 0.7 or 0.8%. So the news was great, and we got the reaction I would have expected, a huge gap up. But it's option expiration week. And with that huge gap up came a lot of in-the-money calls. All of a sudden, there were a lot more in-the-money calls, and the net call premium jumped by several $100,000 just on the Spider and the QQQ. So anytime you have that, you can have problems. So anyway, the Dow, after gapping up, did finish up, but only 100 points. It was up much, much more earlier in the day. The S&P 500 was up 29. Nasdaq was up 113. Nasdaq at one point, I think, was up 450 points. Finished up 113. So again, we finished the day. It didn't feel nearly as good as when we started. Early on, we were up, looked like we were going to try and break out and just take off. And you can see, looking back over the last few months, the Nasdaq opened above. I mean, it was trading at its highest level since back in the early half of September. So there was definitely a chance for the bulls to just take this gap up and run with it. We did not see that. So short term, I think that was more of a bearish signal as we, trade in this trading range. Again, I think yesterday's high, not the high, but the open, which was pretty close to the high. I think that's going to be a key resistance now. And then down here, this was the November 10th gap up I was just talking about a little bit ago. You can see we haven't lost that gap support level. So that, I think, right now is the trading range. And with Max Payne coming up, I can tell you that Max Payne is going to be back closer to the gap up that we saw back in November, because we have been moving higher. Means a lot of in-the-money calls are out there, much more so than in-the-money puts. It's hard to have a whole lot of in-the-money puts when you're trading at a 3-month high. Most folks, when they're buying puts, they're going to buy them slightly outside the money because they're cheaper. You'll have some in-the-money puts, but not a lot. So, I'm not sure if that's why we saw the selling yesterday, but it always makes me scratch my head and wonder. Mid caps up about 0.5%, small caps up a little less, about 1/3. So you can see going across the board, it was anywhere from about 0.3% rise to about 1 full percent. Looking at the various sectors, the only sector that was down was staples, consumer staples. Consumer discretionary opened way up, more than 4%, I believe, and finished flat on the day. So there was a lot of intraday selling in consumer discretionary. One stock in particular was Tesla, which opened yesterday at about 175 and closed at 160. The prior close, I think, was like 167, something like that. So I think we were up 7 or 8 at the open, and we finished 7 or 8 down by the close. Complete reversal on Tesla. We saw that across many, many stocks, many industry groups, many sectors. Anyhow, the leaders yesterday, real estate up about 2.2%, energy 1.9%, communication services 1.7%, and materials up 1.4%. I found this one to be a little interesting, given that inflation seems to be more in line than expected. We actually saw materials gap up and break out to a 52-week high at the open before coming back down. Now, remember energy? Remember when we were moving up here and we had the PPO that was rolling over? I talked about maybe a 50-day test. Look at materials. Materials went up. What's going on here with the PPO? PPO rolling over. That failure on that breakout with a dropping or falling PPO tells me if we don't hold that 20-day moving average, we could open up to that rising 50-day moving average. I'd be a little careful with the materials group right here. 10-year Treasury yield. First of all, no economic news, but we will get the Fed announcement at 2 o'clock today. That will be the big thing that will drive the bond market. Yesterday, we had a pretty big move to the downside. We were up around 360. I actually can tell you exactly where we were. We had closed at 361. That was back on Monday. And then yesterday with that December CPI report, we saw the 10-year treasury yield drop all the way down to 3.42 intraday. We were down 19 basis points with that declining CPI that came out. Now that 3.42 level got down almost to the close where we saw 341 back on December 7th. We got within 1 basis point at 3.42. So I think we've kind of established the range now. To the upside, we've got that 361 level. The 20-day EMA is currently at 363. Monday's high was 363. So short term, that 20-day EMA at 363, I'd be watching overhead, and then to the downside, watch that 340, 341 level. If we break into the 330s, to me, it's just another signal that the yield is on its move to the downside. Eventually, I think that's going to play very nicely into the cards of growth stocks, growth-oriented areas of the market. Right now, a little bit of, I don't know, trepidation, I guess, as you look at the market and you look at some of the growth areas. We are seeing some strength. We're started to see some strength in technology. Semiconductors on a relative basis have been performing pretty well. We'll see if that continues. But right now, and let me give you an update, just make sure we got the latest here on the 10-year treasury yield. Yeah, right now we're just pretty much flat up 1 basis point on the 10-year treasury yield this morning. If you look at a 5-day, 10-minute, you can see that huge drop with that CPI number coming out yesterday, better than expected. Then we rallied back a little bit, never got back anywhere near where we had closed before. So when you look at something like, I don't know, the Spider, which tracks the S&P 500, notice we gapped up. We went all the way back down basically and tested the gap. So again, let me go back and look at this on the 10-year treasury yield. So if the bond market did the same thing, we would have had the yield moving all the way back up to hit 361. We didn't do that. So the message the bond market was sending yesterday was a little bit different than what the message the stock market was sending. And I think some of that could be option related. I think that's why the S&P and the Nasdaq and so forth fell as much as it did. I mean, look at the QQQ, which tracks the Nasdaq 100. And again, look at that huge gap up from 285 and change to almost 297. And 3 hours later, it was gone, completely gone. Oof. That, I don't know. To me, it seems like there's a lot of manipulation in the market, and it is option expiration week. I always get a little, more leery of market makers this time of the month because there is such a huge financial incentive. They're holding a lot of options. And when you're on the other side of a lot of these in-the-money call options, that means if the market goes up, those options become more and more expensive for the market makers. Now, again, if they're doing what they should be doing, what I imagine they're doing is when they're selling the call, they're probably buying the underlying stock. That's a covered call strategy. And that's what I would be doing to protect myself. And I'm sure market makers are doing everything they can to protect themselves because obviously 1 or 2 bad months of options going, against you, market makers could be bankrupt. So they do need to protect themselves. So there's nothing to say that, the market can't just keep going higher. It certainly can, but they can make more money. If they're on board with shorting after the gap, all of a sudden they go from having long positions, closing those out with the gap up, and then take short positions. They've made money on the long side. They're making money on the short side, and they're reducing that premium. It's a win-win-win. So I don't put anything past the market makers as you head into option expiration week. And again, so what caused all that selling? Well, you come to your own conclusions. All I can say is that max pain on the QQQ was down way below 297, where we were yesterday at the open. We've still got some downside, not as much. I think the max pain we calculated last night was like 281 or 282. We got down, went under 286 yesterday, 285.91. So it went from 297 to almost reaching max pain in 3 hours. Pretty impressive stuff. Anyhow, let's keep moving. The S&P 500. So with that action yesterday, you can see we were right up at 4,100, which has been a key area of resistance, not only earlier this month, but if you go back to the rally, remember when we fell, this was the Jackson Hole speech right here. S&P took a big hit. We were in free fall mode, and then we had 4 days of reprieve. That 4-day reprieve ended with a close of 4110. Then here we got as high as 4100. Yesterday we hit a high of 4100. So that 4100, 4110 area is pretty big. You take that out, and I don't really see anything. Well, I guess the Jackson Hole speech itself at 4200, but I'd probably be looking more back to that 4300 level in August. And that, I think, is critical from the longer term perspective, because you're talking about a major bottom in June, a reaction high there, and then we actually put in a lower low briefly, but we did go slightly below that June low before turning back up. If we go back up and take out 4,300 and take out that August high, that would be a trend reversal, in my opinion. You can still cling to lower lows and lower highs as long as 4,300 is not cleared. Once 4,300 goes, that pattern of lower lows and lower highs is snapped. So watch for that. That's further down the road. Probably, I don't think it's as far down the road as you might think, but 4,300 is a level you really want to watch. The close was 4,305 if you want to get really technical there. Nasdaq 100. Also, you can see major gap up here. Highest level at the open yesterday that we had been since back second week of September. So really, really big move there, gap up, but failure with that black candle. It's going to be interesting to see what happens this afternoon. Again, futures down right now. This was as of 10 minutes ago, but I'm showing the Dow futures down 12, S&P down 4, Nasdaq down 22. So looks like we're probably going to start just slightly to the downside. But with that Fed announcement coming out at 2 o'clock, and you look at what was going on yesterday, I mean, are we maybe going to drift a little bit lower, and then when the announcement comes out, maybe have a head fake and then a rally? Are we going to have the Fed talk very, a little bit more dovishly and see a huge rally early and then another fizzle like we saw yesterday? I couldn't tell you. I wish I could. Trying to predict the market day to day, hour to hour is, I'd pull out the rest of my hair, what's left, trying to figure that out. I try to look at the big picture and then just kind of look at where we might go in the short term that kind of fits into that longer term picture. And, using max pain, using these gaps as key resistance, key support, I just think we're in a range right now. And I'm not certain if we go down or we go up. I think, again, with max pain, we have to at least be prepared for it to go down. That's why, in my mind, I think, just kind of using the ETFs like the QQQ or the Spider, whether you're long or short, is probably the way to go, as opposed to the juiced or leveraged ETFs. I mean, you could certainly get lucky and be on the right side of those, but there's a wide range. And if you're in leverage and it goes against you, you could lose a lot of money in a very short period of time. So is it worth that risk? I can't answer that for everybody. All right, so let's take a look. What the heck happened yesterday in terms of the action? I mean, I know where we opened, everything was up, but where did we close? What led? And so we have this relative strength chart list that we have for members. It's a sector relative strength, and then we also have the industry group relative strength chart list. And we just have it on here so that, like a day like yesterday, we can quickly see what finished the day making ground, moving higher. And I mean, technology actually was up a little bit, 0.45%. So that was a good thing. Communication services was up. That's a good thing. But it was sprinkled with some defensive groups. Real estate loves the month of December. Been waiting for a little bit of strength in this group. Maybe this is a kickstart. Lower interest rates should help. But real estate led yesterday. Of course, crude oil had a little bit of a bounce finally. And that helped energy. But when I'm looking at the key groups that I like to follow, communication services, technology, both did okay yesterday. Consumer discretionary, though, again, I mentioned Tesla at the open, just not performing well at all. So let's take a look at a couple of things here. First, I mentioned Tesla, so let's look at that chart. Broke down to a new low. Here's where we were. We were right on this low. That close was 167.87 back on November 21st. We closed day before yesterday, 167.82. So we were 5 cents below that prior close, essentially a double bottom. We gap up yesterday. That was a chance for Tesla. Gapped up, thinking, okay, looks like we got a decent divergence here, nice divergence. I'm looking for a reversal because once we get the reversal, I do think Tesla could make a run to 200. Beyond 200 is hard to imagine at this point because, number one, look at the AD line. Not really seeing anything positive here, unlike many individual stocks. And then also, if we pull up the relative strength on Tesla, look at its relative strength versus autos. Look at the last 2.5 months. When Tesla was, just meandering lower and we have a little move up and then another move down, I was still pretty bullish on Tesla. And one of the reasons why is it remained a leader. I mean, near a 52-week high at the end of September relative to its auto peers. That has changed in a big way in the last 2.5 months. And look at the volume. So we've had an increase in volume. We've had a drop in relative strength. And we've also had the AD line move down near its 52-week low. Nothing in that tells me that I want to be long Tesla. The only thing that tells me that maybe we'll get a short-term pop at some point is the divergence. Now, that can be the ultimate bottom. But this is a daily chart. If we go and look at Tesla on a weekly chart, I'm not seeing any kind of positive divergence. Talked about maybe the positive divergence on the daily, taking it back to $200, which is the 50-day. That's kind of what I look for after a positive divergence. I like to get the PPO back to the center line and or see price action move to the 50-day. So the 50-day is at 200. Now, let's look at the weekly. That dropping 20-week moving average normally on a week chart will provide some pretty significant resistance. Right now it's at 220 and dropping. So it probably won't take long and it'll be down close to that 200 level as well. So again, when we talk about maybe a move to the upside in Tesla, I think, right around the 150 level, there's some support, but maybe if we gap down and reverse off of the 150 level, put in some kind of reversing candle, I think at that point, the risk of being short Tesla probably changes a bit. And I'd probably tend to maybe look more on the long side. But again, that would be a short-term trade. It still would not be anything long-term. Looking at this chart and looking at the relative strength, the AD lines, all of that tells me to be really careful. Now, the other thing that I talked about was energy and the fact that we bounced a little bit. I want you to take a look at the crude oil chart. I mean, we've gone down to $70 a barrel, which we had not been at since back in 2021. We reached a low of 2022 when crude oil hit 70. Last couple of days, we've seen it bounce back up again, but this is not showing a positive divergence. You can see PPO at these two lows, PPO was lower. So this is just telling me that as we're moving lower, the selling is accelerating. The selling momentum is accelerating to the downside. So we've got that we have to contend with. So I think maybe we get up to 77, 78. And I'm not sure crude oil is going to go much higher than that before at least moving back down and testing that 70 area again. Looking at the weekly chart on crude oil, you can see we remain in this downtrend as well. Look at that PPO setting a new low. And that's unlike the overall market. Because if we look at the S&P 500, when we set this new low back at end of September, early October, look at the PPO. Positive. That's why if we break back up above 4,100, right now the 50-day is at 4,103. Remember, we've got on the daily chart, let me pull up that daily chart for you. That's 4105. These two highs are 4100. And if we go back here to that 20-week moving average, that's 4103, right in that same area. So a move through 4105 would be a really big deal, because after a positive divergence develops, I look for a 50-week test on a weekly chart. We've gotten it. Now we're trying to hold the 20-week moving average, which is rising. A breakout above 4105 should be respected. If we close on a weekly basis above 4105, that should be respected on a number of different fronts. Okay, I mentioned the industry groups that we keep look at this chart list with all the industry groups relative to the S&P 500. So it's not how you're performing individually as a group, it's how you're performing relative to the S&P 500. So anything that was green yesterday did better than the S&P 500. Media agencies, communication services group, was the best performing group yesterday. Energy, probably going to see a couple of these energies on here. Well, there's one at the very top, but there's technology, there's industrials, real estate, communication services, real estate. There's a staples group. Staples actually was the worst performing sector. So that's kind of interesting to see one of the groups up there. Financials, real estate. There's consumer discretionary, communication services, financials, and then finally a materials group down here, and then technology. But you can see there's a lot of the aggressive groups still sprinkled in there. If we flip this and look at the worst performing groups, we're going to see airlines. There's autos, thanks to Tesla. And then we get into a couple of the more defensive groups. We've got healthcare providers, consumer staples, that's the distillers and vintners. And then I've got a few other industrials, got two industrials. Travel and tourism, that's part of the consumer discretionary. All of these groups underperformed yesterday. Now, I don't see on this list going down here, I don't see one single technology group. So let's see how far I go to get to a technology group. I'm looking for XLK down here at the bottom. There we go. Telecom equipment, barely underperforming. That was the worst technology group yesterday. And I don't know what, there's 104 groups, and I don't know how many I just went through, but I don't know, it's probably 30 on a page. I mean, we're probably down to 50, probably halfway down before we got to one group in technology on the bearish leaderboard. And yeah, I thought that was kind of interesting. Let's see. To wrap the show up, why don't we do, well, first I'm going to pull up the, let's just see where we're slated to open here. The diamond pre-market right now is flat. The SPY pre-market down a little more than 0.1%. And the QQQ down 0.25%. So looks like a slightly lower open that we're staring at. If we go back, let's take a look at the three best Dow stocks yesterday. I don't even know which ones they were, but CVX, Merck, and Salesforce.com. So CVX in a downtrend, bounce back, got to get through those two moving averages. Right now, not really looking very good. At the top, look at the negative divergence. See that PPO rolling over while prices were trying to go higher? It's normally not a good thing. And as a result, we ended up going back down to the 50-day. I think your support's down at 165. That was where we had topped previously. So we got a little bit more downside to 165. I would expect this to fail at the 20 and then maybe come back down. So 175, 176 might be some resistance there. And then maybe we get a 165 print. Second one was Merck. Merck trying to go higher yesterday. That PPO as well, trying to roll over there. I don't know. This one looks like, volume picked up yesterday. If the volume can continue to be strong and we get the breakout, I would ignore the negative divergence. But if the volume starts to trickle off, or we just simply can't get past that 111, 112 area, I'd be a little careful. And then the third one was CRM. Was it CRM? Yeah. Salesforce. And Salesforce just recently broke down. Look at all this volume right here with this breakdown. So we've got price resistance right around 140, 139, 140, and we got the declining 20-day moving average at 141. I would think we're going to struggle there on CRM. So these three stocks that performed well on the Dow yesterday, I'm not exactly overly bullish on those stocks as we move into today's action. All right, that is it. The market has opened. So let's just see where we are, see if we're close. Yeah, I mean, Dow actually up 58, S&P up 2, Nasdaq down 5. So a little bit of underperformance on the Nasdaq, but we are close to the break-even point. Remember, today is Fed Day, 2 o'clock. I'm not sure what the market's going to do between now and 2 o'clock. Usually, it tends to be a little quiet. I mean, with yesterday's good news, I would expect maybe we'd see a little buying into it with traders, getting a little bit more aggressive, thinking that the Fed's going to turn more dovish. Of course, that's what would make sense to me, which probably means it'll do the opposite. Hard to tell what's going to happen. Just remember, volatility after 2 o'clock is likely to be off the charts. We may soar initially and then sell off. We might have what looks like a crash if the Fed says anything, that they may stick with this rate hiking campaign. I think that would really spook the market. I think the market's beginning to look now for the Fed to finally come on board. I mean, the bond market is now, we've seen the yield go down 90 basis points. That's a lot. 90 basis points from 430 down to 340. Bond market is telling the Fed rates are going to come down. The market is expecting the Fed to be dovish, or at least to begin, to start saying more dovish things. I'm not saying they're expecting the Fed to lower. They're not going to lower. They're going to hike rates today. But their tone and what they say about the upcoming months, I think that's where the market is expecting the Fed to basically say what the bond market's been saying. And if they don't, that's what I think, that could be a big problem for the market today. Anyhow, that's it. Have a great day, everybody. I'll be back tomorrow over at Stock Charts TV. Just click on that at 9 a.m. Check out the next Trading Places Live. And again, don't wait. Register now for our free virtual event, Market Vision 2023. It's going to be here before you know it, Saturday, January 7th. Make sure you get a seat. Have a great day, everybody. Happy trading.